Welcome, everyone. This is Tracey Velt. I'm the Senior Director of Data and Content for HousingWire, filling in for Sarah Wheeler this week. Today, my guest is Logan Mohtashami, and we are talking all things chaos in the market, jobless claims, and also purchase apps. So enjoy the podcast. Hey, Logan, how are you?
I am wonderful, and the hair is crazy because this week is crazy again. Last time you and I talked, we discussed, during the trading hour a few days ago, there was a rumor and a wire went out that the Trump administration was going to do a 90-day pause, and the stock market went up vertically. And then they came back and said it was fake. And you and I talked about, I don't think it was fake. I think it's just a test run, a trial run to see what would happen so they could have cards. And of course, the next day, I got off of another event. The first thing that I see 2 seconds after the event, 90-day delay. And stock market had a huge rally. They raised the tariffs now to China to 145%. Stock market is down big again today. Yeah. So the hair is just, we're going to keep the hair wild until we get some clarity here.
Yeah. I mean, what does that mean? Obviously the administration is looking at the yields and bond market and everything, and maybe making some choices based on that. But how does it tell me that and what's the impact?
Yeah, this is my take. We had a near bear market in 2018, and there are limits to what Trump will tolerate with the stock market. He didn't mind. There was a few corrections back then, and a near bear market. But the bond market, I always tell everyone that the stock market is one thing, but the bond market is mother god to everything. Right. And it is interesting that, the bond market reaction, it was so swift on overnight trading, but in aggregate, in big theory, it wasn't like a total crazy move. Like I saw people can say, oh my God, nobody wants the US debt. There are some men out there that should never be trading stocks or bonds or anything, man. They are just the softest little marshmallows. Oh my God. Everything is nobody wants or didn't know. That's not us. But you could clearly see that the bond market was front and center with the White House, because there's one thing for stocks to go down, and there'll be implications to that. But if the stock market goes down and then the 10-year yield goes up, that wasn't the marketing plan, right? You see all these conservative Twitter accounts, they're all like, oh my God, the 10-year yield is under 4%. The tariffs are working. And now it's like, what? Wait a second. So unfortunately, Mother Marketplace, I always joke with Sarah about this, Mother Economics, she's a serial killer. She wants to get caught. Mother Bond Market is telling you, don't mess with me. Just don't. Just whatever you want to do. Let's just keep it somewhat tame, because if I go reversal on you and bond you, let me do a hypothetical theory here. If the 10-year yield was north of 5.25 and like going up higher, that is a legitimate bond market scare, because the Fed funds rate's at 4.5. They're not hiking anything. If they were talking about hiking rates, okay, you can make a case. If something like happened on a daily basis, that's not a good thing, because that's something different. So you could see there are levers now to pull. The problem with something like this is you're showing all the cards now. And this was the concern. Sarah and I had this podcast a few weeks ago where I said, sometimes you might push yourself in a situation that you didn't really want to get into. And I don't know if you know how you want to get out of this. Like if you're going to make deals in the next few weeks or 2 or 3 months, okay. But now it's like everyone's seen the playbook, right? And I don't know, to me, that it wasn't so much the stock market, it was the bond market. And that you could see there are things that can get their attention. And this because I see a lot of Trump people talk about, hey, the 10-year yield's down, the 10-year yield's down, the 10-year yield's. where for me, it was like last Friday, I was talking about the 10-year yield really should be at 4.35%. Oddly enough, it kind of closed there yesterday. And I was thinking, this looks about right. But here, the volatility today, stocks are down big. The 10-year yield is up a little bit from the lows. So there's less volatility today in Thursday's trading, but you can see pressure points. And, I think Q told James Bond, never let him see you bleed and always have an exit plan or escape plan, So here I'm wondering what the backdrop of the conversation is that now that, the cards are all out there, bond market is really the key here. Oil prices are down, of course. The inflation report was very tame today, but going out in the future, it just gets more interesting.
Yeah, it sure does. Let's talk about that inflation report. Talk to me a little bit about what you're seeing on that end.
I wrote the article yesterday saying that the Fed is going to really need to see labor market break to get some aggressive cuts. So I'm going back to before the trade war, before Trump won, the Federal Reserve said, okay, we cut rates. We are going to take a moderate approach because we're in a good spot. So they had 2 rate cuts priced in for 2025. Now, the interesting thing is the marketplace is trying to call their bluffs. The marketplace is saying, no, you're doing 4 rate cuts. Fed President Goolsbee came and said, hey, the market's ahead of us. We don't have to do that. There's already a verbal tiff between Fed presidents saying, hey, what are you doing with 4 rate cuts? We're not there. The hard data looks good. The soft data looks bad, but the hard data, so it doesn't. So now you're getting into what I didn't want to see happen, which is going to be the case. There is going to be an all-out war for Trump against every Fed president out there who doesn't. Because if the economy goes into a recession, let's say investment really slows down, consumption goes down, this trade war shock puts us into a recession, and the 10-year yield doesn't go anywhere, doesn't go down, there's no aggressive Fed rate cuts, all hell is going to break loose in that. You could see the original game plan with everything, because when you incorporate a trade war into an economy, naturally people are going to invest less, consume less, because they're not sure until the rules are set. So the White House economic team was counting on the 10-year yield falling and oil prices falling to soften the blow a little bit. Oil prices have fallen. The 10-year yield has fallen a little bit. We talk about this. Purchase application data is positive. The last print had double-digit year-over-year growth, 9% week to week. But they really need that 10-year yield and mortgage rate to go lower with oil prices to soften the blow until they figure out what the final verdict here is. And the inflation report, tame, month to month was negative, actually. It's the first, I think, decline since 2020. But it's the same thing as always. The growth rate of inflation, the pandemic caused inflation to break out. And now that supply chains were working again, the growth rate of inflation falls down. This is the history of global pandemics for centuries, right? There's nothing abnormal here. But we're talking about monetary policy and where they want to get to. And obviously, the White House wants a lower 10-year yield. They would love a lower Fed funds rate. And the Powell and the Fed presidents are still, we're going to wait. We're going to wait. We penciled in 2 rate cuts. They're not necessarily saying that's off the table, but they're going to wait. And the thing about waiting is all this chaos is happening while it's waiting. So it's a little bit more complicated, but if things do progress worse, where the hard data starts to get worse for the Fed, it'll be interesting to see how they react, because the marketplace is saying, hey, listen, you're cutting 4 times this year. And I don't know. It's just it's a battle between Fed policy, the White House, the confusion around the tariffs, the trade war tap dance, and there are things that can be done this fast to change everything. So we'll see kind of what happens in the next few weeks. But the volatility, right? We talked about this on November 7th, 2024. Guys, get ready. Oh, this is going to be much different. And for those of us that remember 2018 and 19, this is the bigger version of that.
Yeah. So what about jobless claims?
Jobless claims looked good. Jobless claims looked fine. The labor data is fine in the context that the labor market is slowing, but not breaking. So for those of you that are new, part of the HousingWire Daily family now, at the end of 2022, I believed whoever this person was went to the Fed's Christmas party and spiked the Fed's eggnog. And they said, we're going to be super, super hawkish until the labor market breaks. Because before somebody spiked the Fed's eggnog, Jerome Powell went on TV. I'll never forget this. He said, we would like the Fed funds rate to mirror 3, 6, 12-month inflation on the PCE side. The Fed funds rate is 3% today, if that's the case. CPI inflation came out 2 handles, on some of these things. It's not that they don't see the growth rate of inflation falling. It's just that they believe they need to keep the Fed funds rate above the growth rate of inflation until the labor market really starts to break. They reversed their entire policy after a Christmas dinner. And then we're dealing with this now. In the past, they would have been more, aggressive in maybe cutting rates and getting to neutral, but they're not in this policy right now. So it doesn't really matter that the inflation report was soft or tame, right? They are keeping their policy. They say it's modestly restrictive, which in their eyes would be a fair statement. But to me, the only time they blinked is when we started to get really big revisions, negative revisions on the jobs report. They're like, oh, 50% hike, 50% rate cut. Let's do another 2. So they put themselves in a position that they can act now with a little bit better backdrop. It's just the course of when are they going to act next? Do they just go ahead and cut twice this year? Or does the trade war bring us into a weaker, harder data where they're saying, hey, listen, well, we have to do our dual mandate? That's going to be the conflict, right, between the White House, the Federal Reserve, the dual mandate. But I say not a dual mandate anymore. I say a duel, right? It's going to be Trump and Powell, wild, wild west, 6 shooters out, walking 10 feet. And that aspect gets more interesting the longer this trade war goes on.
So what do jobless claims have to be to break?
To me, the levels that I set back in 2022 is 4-week moving average jobless claims have to head toward 323,000 and break that. And that ties with every single recession we've seen post World War II. It's from the 60s when they started carrying this data line. I always adjust everything to the civilian workforce, so my numbers might be a little bit different than others. But for now, look, it held. Think about all these recession calls in 2022, 3, 4, 5, but the jobless claims data still came in. It was 223 on the headline jobless claims. I like the 4-week moving average because weekly data could be very volatile. The 4-week moving average is 223,000, oddly enough. So we're like 100,000 away. But when things break, they break fast. This is not something that just kind of creeps up and then all of a sudden, it starts to break. And that means the economy is in such a contraction that it doesn't have like these few weeks where it goes up and then comes back down. So I've always thought the goal is to prevent something like that, but it's a more complicated year in 2025.
So let's go into purchase app data. What's going on there?
Yeah, now that is, some people were surprised that it was positive. It was a very strong report on a week-to-week and year-over-year data. Always remember that the rate drama that we had just happened. So it's most likely that it's next week's data that's going to get hit. And whenever we see rates spike up, I mean, it's not that big of a move in context. We actually went from like 6.75 to 6.55. Then we went up to 7% and we're a little bit lower than it. But whenever that happens, the index, especially that it's been rising, it typically fades. But this will be this will be a good test. Like, it's not like mortgage rates got to 8%. The data line was getting subjectively a little bit better, even with a 7 handle on the low side. So we'll see how much damage that rate move did. I always think the volatility of rates doesn't get enough attention in terms of how people operate in real estate. You get a bunch of people that go, okay, I quoted you a rate at 6.5%, and then 24 hours later, what? It's 6.9. That's a detriment. On the up or downside, the speed is just you don't want to see that. You want to see a kind of a calm situation. But again, chaos. Mother economics, mother bond market. She doesn't play around. You cannot control her, man. You do stuff like this and things get wild. And we obviously see that in the stock market, which is really interesting now that we think about since the point of Liberation Day, stocks have continuously gone down outside of the 90-day tariff, removal from a lot of companies or a lot of countries, but we still had it for Mexico and Canada and China, which are our big trading partners. So the question is now, over the next few days, what happens? If things get worse, do they make another deal, or they can't really come out and do another headline news, or do they just kind of hold their ground and just let the market do its thing? But it's the bond market that is the key. So for right now at 4.36, I think right now is the last time I saw it's okay. But purchase apps, it's really interesting. All of our data is still positive year over year on a week-to-week basis too. And it's been a while since I could say that in April, but it is really encouraging to see growth with elevated rates. And I got asked this question, like, how do you explain this? Like, how is this? I go, first of all, number one, always, we are working from the lowest levels of sales ever. This is not, you can't compare this to 2008. You can't even compare this to the lows in the early 1980s at 2 million. We have over 162 million people working. We have over 340 million household formation, all these things. When you think of home buying, you think of the 5 kind of pillars of home buying. There's first-time home buyers, move-up buyers, move-down buyers, cash buyers, investors, but you also have 5 generations, Gen Z, millennials, Gen X, baby boomers, even the silent generation are still buying homes. So you have a big swath of home buyers, and it's not like we have underwater mortgages holding people from selling. We have a ton of equity. Oh my God, $38 trillion of equity. It's not like credit is being retracted. If Freddie and Fannie were publicly traded companies and the markets were doing like this, you could make a case that maybe Freddie and Fannie is going to retract credit, because this is what happens in times of stress. But that's not the case. They're still in conservatorship. So you have the things in place. It's just sales are really low. And every year that goes by, wages grow. Every year that goes by, household formation. Every year goes by, dual household incomes. See, when you put 2 household incomes, the affordability levels don't look that bad. So this is why we have near 5 million total home sales. So we look at 2010 to 2019. The peak during the last decade, combined them, was near 6 million. We're near 5 million. We're missing 1 million mortgage buyers. So rates go down, you get a little bit more demand, you start to get back to the retracement of the last decade, which would be kind of normal. So it is interesting that we say this, but it's true. Existing home sales have collapsed to a very low level. New home sales are at 2019 levels still. You get lower mortgage rates, you get closer and closer to what we used to have in the previous decade, because new home sales are still elevated, but the existing home sales, it doesn't take much to move the needle. And it's just the sheer size of our workforce, the sheer size of our dual household income. So you get a little bit of growth. But if it just heads to 6% and stays there, we could run this entire year positive, which would be, it's been so long since we've seen that. But there are some similarities to other periods. I always say the 1980s, early 90s housing market looks so much like the early 1980s, except the only thing is we have less inventory now. We have better homeowners, better financials. But we have a lot more equity now as well. But even in the 1980s, with affordability worse, even with 2 recessions, more inventory, nobody can buy a house, inflation, all this negative things that were said back, rates went down 2% plus. home sales went vertical higher. This is why I always like to show the 1980s existing home sales chart for everybody, because it was worse back then and still home sales, because millions and millions of people buy homes every year.
So, Logan, that was great. Do you have anything else that you want to add to the conversation?
Yes, this morning, this podcast is going to come out before, but we are going to have a housing economic webinar for the first time ever. Myself and Ivy Zellman will be speaking at the same event. Dale, who's a Wall Street analyst, will also give his, a long-term kind of take on the structures of the housing market, which was going to be very interesting. You could register online, free webinar, but I think you consider everything that's happened, this year and all the things that are showing in the housing data. It'll be a very interesting conversation to see our takes on where we are right about now.
I am looking forward to it. Thanks, Logan.
Thank you so much.